This week, we've been talking about the strong performance in US equities in July last month due to the possible Fed pivot, but it's always important to keep an eye on the US consumer. To discuss this, I had a conversation with the Director of Consumer Research at Refinitiv, Jerome Martis. Jerome, welcome to the big conversation.
Thank you. It's good to be here, Jamie.
One of the reasons cited for the recent rally in stocks is that essentially Q2 wasn't as bad as people were expecting. Now, there are many analysts who say there is weakness coming, but it's just been delayed and it's going to come in Q3 earnings. So what I'd love to hear from you is, from a consumer spending perspective, what are you seeing at Refinitiv and what are you expecting Q2?
Sure. So retailers are about to start reporting earnings for the second quarter. So far, we have about 80 companies in our retail and restaurant index that have reported earnings so far for Q2. The overall index is looking at a negative 14.3% earnings growth rate for the second quarter. Although this is still in a negative territory, it is an improvement from the first quarter. And the strength that we're seeing in the second quarter is mainly from consumers who booked their travel at the beginning of the year and are going no matter how high gasoline prices are or despite the inflation right now. And this is also in line with a lot of the credit card data, right? That shows that consumers are using their credit cards again. Spending is going up, but it's mainly going for travel, restaurants, and those experiences after being locked down for 2 years in their houses. So they're not using their credit cards yet for everyday expenses, but they are still spending and they are going no matter what on that revenge travel this summer.
Very interesting. So when it comes to having fun in terms of travel and restaurants, people are willing to still keep going to those.
Yes, and they're not shopping so much for clothing or shoes, but definitely they want those experiences regardless of how higher, despite of higher expenses.
Yeah, okay. Well, that explains certainly some resilience. Now, another thing that often gets cited is that inflation impacts different consumers in different ways. So what I was hoping to get from you is just a little bit of color in terms of what trends you're seeing at the high-end consumer and, are people and what trends you're seeing in the low-end consumer.
Absolutely. So the low-end consumer is being squeezed the most because they're no longer receiving those the checks the stimulus checks they were receiving from the government last year. On top of that, their spending power has come down because of inflation. So what they are doing, and what we're already seeing that low middle class consumer doing, is that they're staying near their houses. They're shopping, for example, at the dollar stores, and they're going there for all their basic necessities, but they're going to the nearest store. Now, the middle class consumer itself, they are looking for value. They're cutting up their Netflix subscriptions and instead using that money to get a Costco, Sam's Club, or BJ's membership in order to pay less money at the gas pump. They're trying to find ways to save money. Now, the high-end consumer, they're firing at all cylinders. The luxury retailers are raising their prices and they're passing those on to that consumer who's willing and able to pay that. As a result, names like Louis Vuitton, Hermes, and even Lululemon, they are expected to see stronger revenue and earnings compared to even pre-pandemic levels.
Right, I see. So those higher end retailers are managing to ride this wave a little easier. Now, just another thing is that one thing that appears to be giving the Fed a lot of confidence is a tight labor market. So I'm wondering, is there any evidence to suggest in what you're seeing that, this strong labor market is giving the consumer more confidence?
Absolutely, and this is reflected in our Refinitiv consumer confidence report. What we're seeing is that the consumer confidence sentiment, it consists of 4 sub-indices. And the one index, the job index, is the one that consistently has been positive throughout 2022 this year. However, it did decline last month, showing that consumers are starting to be a little bit concerned about their job security. But the fact that it's remained positive for most of this year is what's telling us that it's the reason why consumers have remained engaged. The one economic indicator consumers understand very well is the unemployment rate, the job report. And if they feel that their friends and family, and they start seeing that their closest group of friends or family start losing their jobs, that's when they're going to put their hands in their pockets and hold back on spending. As long as that employment report remains positive and the unemployment remains at low levels as it has been throughout this year, we will continue to see the consumer remain engaged for the rest of the year.
Okay, so when it does come to the outlook for consumer spending, keep a close eye on unemployment rate because it really does make a difference.
Absolutely. They're strongly correlated one to the other.
And Jerome, if you don't mind, like one last question, let's talk about outlook for a second. Going out into Q3, how do you expect consumer behavior to change? Has a lot of the maybe strength, let's say, that's come into Q2 from people wanting to still travel and go to restaurants? Do you see that fading into Q3? What sort of trends are you looking for?
So retailers are reporting uh, second quarter earnings right now. So about 80 companies, that's 40% of our index have reported so far. Out of those 80 companies, more than half have reported that they're very much concerned about the inflation, and nearly all of them, 70 of those 80 companies, are still strongly vocal about supply issues into the third quarter. So as a result, we're receiving a lot of negative guidance for the third quarter from a lot of retailers who are telling us not to expect too much to them. And as accordingly, the analysts pulled by Refinitiv are lowering their earnings guidance for the third quarter. This is also in line with what we see historically. Historically, what we see is that consumers do spend in the second quarter, but then take a slight break ahead of the holiday spending in the fourth quarter. So don't be surprised if third quarter comes in slightly weaker than the second quarter, but then picks up into the fourth quarter. So far, even looking at the third quarter, the strongest sector remains the hotels, restaurant, and leisure group because consumers after the 2 years of being locked down in the house, there's a lot of strong demand there, and they like I mentioned before, they're willing and able to spend money on experiences, even if that means extending themselves and using their credit cards.
Got it. So there is some seasonality in Q3 anyway, which people should watch out for. And I think if I'm right, something else you're saying is these higher end retailers are just more able to pass on these price increases. So they seem to be in a little bit better position anyway.
Absolutely. And what's going to drive that middle class consumer are those deals, especially during the Black Friday season, because as long as the retailers, and this is a strategy we've seen them using before, they lure the consumer in with a certain amount of discounts, but they won't have everything on discount in order to motivate them to pay full price for the other items.
Got it. Jerome, it's been so great chatting with you. It's always a pleasure to have you on the show. Thank you so much.